You know the dream, right? Passive income. Getting a piece of those huge real estate deals without ever having to be a landlord. That's the promise of real estate syndication. But what happens when that dream twists into a total nightmare? We're going to dig into how that amazing promise of passive income can turn into a financial disaster, and more importantly, how you can see the warning signs before it's too late.
Just let that sink in for a second. This is a real quote from a real investor on Reddit. Imagine opening your email to find out that $50,000 of your hard-earned money has just vanished. Poof, gone.
So that's really the big question we're tackling. How does this even happen? Is it just a string of bad luck, a down market, or were there red flags from the very beginning that maybe got overlooked? Let's break it all down. Okay, it all kicks off with what I like to call the syndication seduction. The idea itself is just so appealing. You get to own a piece of a massive apartment building or a cool commercial property, and you don't have to deal with any of the headaches. Let's see how that's supposed to work. The concept is actually pretty brilliant. You have a sponsor, they're called the general partner, or GP, who finds a great deal. Let's say a huge apartment complex. They can't buy it all themselves, so they pool money from people like you and me, the passive investors or limited partners. In return, you get to own a slice of a massive asset you could never afford on your own. The dream is to just sit back and watch the checks roll in. And for so many people, just like that investor on Reddit, this is exactly where the story starts. You find a super charismatic sponsor, maybe they're a big real estate influencer on social media. They show you this incredible opportunity, flash their portfolio of past successful deals, and project these amazing returns. It's really, really easy to get swept up in the excitement.
But hold on, before you get too carried away with those glossy projections, you have to understand that these are not just simple handshake deals. They operate under a really specific set of legal rules, the rules of the game, and you absolutely have to know them. It's non-negotiable.
So think of it like this. You, the limited partner, you're a passenger on a plane. You bought a ticket, that's your investment, and your risk is limited to what you paid for that ticket. You can't lose more than you invested. The general partner, on the other hand, they're the pilot. They're flying the plane, they're making all the calls, and they carry all the responsibility for the operation. Understanding this difference is the absolute bedrock of any syndication deal. Now, how you even find out about these deals is tightly controlled by the SEC, and this is where it gets really important. It boils down to two big rules. With Rule 506B, a sponsor can't advertise. They can only raise money from people they already have a relationship with. But under Rule 506C, they can advertise to the general public. You'll see these on social media, podcasts, you name it. But here's the catch. They can only take money from accredited investors who are people with a high income or net worth. This one little rule changes everything about who sees the deal and how it's pitched. Okay, we know the players, we know the basic rules. Now we get to the most important part of all, how to spot a bad deal before you write that check. Let's perform an autopsy on a deal gone wrong. Your number one defense is due diligence. Think of it as your shield. It's the hard work of digging through the numbers, questioning the assumptions, and stress testing the sponsor's whole story. This isn't about being negative. It's about being smart with your money. All right, let's get into the specifics. Red flag number one, and this is a huge one. If a sponsor ever guarantees a return, that's not just a red flag. It's literally an SEC violation. You need to run. Another big one to watch is the exit cap rate. A good sponsor assumes the market might be a little worse when they sell in 5 years, meaning a higher exit cap rate. If they assume it'll be lower, they're basically betting on a perfect future, and that's a dangerous bet to make with your money. And here's a perfect example of what I mean by aggressive assumptions. Let's say a sponsor projects that rents are going to grow by 8% every single year. I mean, that sounds amazing, right? But a much more realistic, conservative number is around 2 to 3%. Now, that difference might not seem huge, but when you compound it over 5 or 7 years, it completely changes the entire financial outcome. It can literally be the difference between a nice profit and losing everything. And it's not just about the numbers themselves. It's about how they're presented. Is the sponsor totally upfront about all their fees, or are they buried somewhere in the fine print? Is the investment summary a flimsy 10-page pamphlet or a detailed, professional 100-page document? Heck, even typos and bad grammar matter. It all speaks to their professionalism and attention to detail. If they're not transparent from day one, you've got to ask yourself, what else could they be hiding? And that brings us to a really critical legal idea. You see, the general partner isn't just working for themselves. They have a legal and ethical duty to you, the investor. And when that duty gets broken, well, things can get really, really messy.
The term is fiduciary duty. It's a fancy legal phrase, but it means something really simple. The GP has a legal obligation to act in your best interest, not their own. It is the absolute highest standard of care in the law. It's the entire foundation of trust in this relationship. And when that trust gets shattered, you get situations just like this famous court case. So check this out. The case is eBest v. Bruce, and it's a textbook example of fiduciary duty being breached. The new general partners found out there was a chance for the partnership to buy back its own debt for way, way less than it was worth. A huge win for all the investors. But instead of presenting that opportunity to the partnership, they secretly bought the debt for themselves and pocketed the massive discount. Well, the court was not having it. Their ruling was crystal clear. A partner cannot take an opportunity that belongs to the partnership and keep the profits for themselves. They basically stole a corporate opportunity, which is a massive no-no. The court forced them to give all those profits back to the partnership where they belonged. So what happens when it all goes south? Let's go back to our investor who lost $50,000. Is there any way for them to get it back? Or is it truly a point of no return? Well, the hard truth is, once the money's gone, getting it back is a serious uphill battle. That mountain of legal paperwork you sign, that operating agreement, it was written by the sponsor's lawyers, and you can bet it's designed to protect them, not you. Suing is incredibly expensive and can drag on for years, with absolutely no guarantee you'll win. But that doesn't mean you're totally powerless. If you find yourself in this nightmare scenario, there is a playbook you can follow. First, go back and read every single document you signed. Then, you formally request the financial records, the ledgers, the bank statements, everything. You're looking for smoking guns. Did they sell the property to a company owned by their cousin? Were there a bunch of hidden fees? Once you have your evidence, that's when you take it to a securities attorney to see if you have a real case. And really, that's what this all comes down to. While there are a few things you can try after a deal goes bad, the absolute best defense is prevention. The goal isn't to get good at suing people. The goal is to get so good at your own due diligence that you never have to. So the real question to ask yourself is this. Now that you know what to look for, are you truly prepared to spot those red flags before you ever write a check?